So you're concerned about what if? What if you get sick? What if you need a nursing home? And you're concerned about spending tens of thousands or even hundreds of thousands of dollars in a Medicaid spend down. That happens to thousands and thousands of Americans every year. They save their hard-earned money only to give it all away to the nursing home. And you're asking yourself, how can I protect myself? Well, good news, there's 4 ways to address long-term care insurance. But before we get into that, make sure you subscribe to our YouTube channel. If you enjoyed this video, click the thumbs up, give us a like, and make sure you share this video with your friends. Let's get into it.
He watches the markets.
In the great city of Memphis, Tennessee.
If they raise rates tomorrow, it could be a sign of confidence.
The financial advisor extraordinaire.
He's with McAdams Group.
Of course, Wall Street doesn't like rising interest rates.
And I know people from all over the Memphis area come to visit you for help with their RMD.
David McAdams is with us.
David McAdams.
David McAdams.
There are exceptions to the rule.
That's very interesting because that's kind of against conventional wisdom.
That's the insanity of it.
All right, so you're sitting there and you know someone, or you have a loved one, a friend, a family, a cousin, a mother, a parent, an aunt, an uncle, and you watch their health decline. You know, 2 out of 10 people die suddenly, but what happens to the other 8? Well, their health declines. They get sick first. They have some problems. And if they're blessed, they don't get into a lot of money before they die. But so many people end up spending tens of thousands of dollars in what's called custodial care. And you're watching this video because you probably want to know, how can you avoid giving all your money to the nursing home? And so, you know, here's the thing that makes this so tough. Most of you have heard of something called insurance. You've heard of long-term care insurance. You're not sure whether you should buy it or not. We're going to talk about that. But, you know, what makes this decision so hard is the cost of insurance has become so expensive. So you might be asking, are there other solutions? Are there other things I can do to protect myself and my family from this catastrophic Medicaid spend down? And here's why this makes it so tough. We know the numbers. We know that if you're 65 or older, there's a 1 in 2 chance that you'll need custodial care between now and your last breath. You heard that correctly. There's a 50% chance that you're going to need custodial care, okay? Also, if you're a married couple and there's 2 of you, that changes the odds, doesn't it? There's an even greater chance. It's higher than 50%. There's a high likelihood for a married couple that you're going to get into some money here. You're going to need custodial care. Here's something else we know. We know that when it happens, it's very expensive. You know, in my little town in Memphis, Tennessee, the average cost of a nursing home today is about $7,000 a month on average. Now, there's some that are a little less, some that are a little more, but $7,000 a month on average. That's $84,000 a year. In some areas, it's much higher. Depends on where you live. But why is it such a hard decision? Because we don't know who, we don't know when, and we don't know how long. You know, if we know those 3 variables, we could just say, you people need to self-insure, you people need to go on Medicaid, and you folks need to buy insurance. It would be that simple if we knew who, when, and how long. But we don't know any of those things. So what can you do? Number 1, many of you are doing this now. One option is to self-insure the risk. Now, this has become harder and harder because we're in a low interest rate environment. Think about it. Think about 25 years ago. Let's say you had $500,000 in your nest egg, and you could walk into a bank and they would give you 5% interest. So that's $25,000 a year. Or maybe you had $1 million and you could get 5%. That's $50,000 a year. Good news, back then the nursing home was $2,000 a month. So imagine you had $50,000 in interest and you had $24,000 in nursing home expenses. You could self-insure the risk. In fact, in a study that was done about 20 years ago, at the time, they said if you had $0 to $300,000, you probably did not have enough accumulation to worry about buying insurance, and you certainly couldn't afford to self-insure. So you would have to do some different planning we'll get to in a minute. They said if you had $300,000 to $1 million, you had enough to preserve, but probably not enough to self-insure. So you needed to buy insurance or do some other form of planning. But back then they said if you had $1 million, you could probably self-insure the risk. But guess what? This is not 20 years ago. The nursing home isn't $2,000 a month. It's $7,000 a month or more. And the bank's not paying you 5%. If you're fortunate, you're probably getting 0.5%. So you take that same $1 million to the bank that used to throw off $50,000 of interest, and instead they're giving you $5,000 of interest. That doesn't even pay for 1 month of nursing home. You know what? To self-insure the risk today, many experts say you need to have accumulated $3 million or more to self-insure the risk. If you don't have $3 million or more, and frankly, that $3 million needs to be properly invested to generate enough income, true income, in the form of interest and dividends to pay for the nursing home. But if you don't have $3 million, you probably shouldn't be entertaining option one. Option one is to self-insure. What is option two? Option two is tricky. Option two involves what's called Medicaid planning. You know, some people can structure their affairs to basically on paper look indigent because under today's Medicaid rules, depending on your state, you basically have to be indigent. I know in my state, they'll let you keep $2,500. They'll let you keep the family Bible. And pretty much if you have anything else, they want it. They're going to make you spend down your assets. We call it a catastrophic Medicaid spend down. They're going to spend down your assets. And basically when you're broke, they say, great, come fill out some forms. We'll see if you qualify for a government program. This is basically welfare. It's a social welfare benefit that you paid into for years if you were working. They're taking money out of your paycheck. You remember they take certain things out of your paycheck. You're probably withholding income taxes. You're withholding, your FICA, your FUTA, your SUTA, your Social Security, all that good stuff. Part of that went into the Medicaid system. You paid for it. But let me ask you a question. Is your goal to become financially indigent so you can lose control? So you can get on a social welfare benefit system? I doubt that's your financial goal, is it? But some people will do legal planning. And there are certain types of trust. You got to be really careful because this type of trust is called an irrevocable trust. Irrevocable. Now, if you really want us to do one, we can do one for you. All right? You can click on the link below. You can fill out a simple 60-second questionnaire. You can talk to one of our estate planning specialists. And if you want to do Medicaid planning, we can show you ways to avoid giving the money to a nursing home. That's option two. So you've got option one is to self-insure. Option two is to do Medicaid planning. What's option three? Well, it's good old-fashioned insurance. You've heard of long-term care insurance? It's a tricky decision. I'll tell you why. It's very expensive. If you were blessed enough to be my parents and get it 20 years ago and buy what I call the Cadillac, the best long-term care policy on the planet, yes, they're very blessed. They pay very small premium. They've had very few rate increases in the last 20 years, and their benefits are amazing. They have a very rich benefit structure. They have lifetime benefits. Right now, if they got sick, their benefits pay over $90,000 a year each, and they have an inflation protection where the benefits go up every year. But if you're exploring long-term care insurance in this day and age, I have some bad news for you. Number one, it's harder and harder to qualify. Number two, there's so many companies have gotten out of it. They just threw their hands up and said, this is bananas. The claims are out the roof. People are living longer. They're getting sick. The insurance companies are losing their shirt. So many of them just said, I'm out. And they stopped offering long-term care insurance. The ones that still offer it, the premiums are bananas. They're through the roof. And guess what? If you buy it, you can almost bank on significant ongoing rate increases. And unfortunately, many people that bought long-term care insurance 5 years ago, 10 years ago, it's already become unaffordable, and they've either had to drop their insurance or they've had to make changes to decrease the benefits significantly just to keep the policy. Now, what's the fourth option? The fourth option could be interesting. It could be interesting. Many of our clients have used option 4. It's called asset-based planning. You see, the insurance companies have become very creative with this. They've got certain things that you can fund with either a lump sum, or you can fund it where you can control the maximum premium cost. You can actually say, hey, I only want to put money in this for 5 years and then I want to be done forever. Or you can put money in for 10 years and then be done forever. You can structure it to fund it in a way that fits your budget and your funding ability. And in a perfect world, maybe you just throw a lump sum in there and you're done with it. The asset-based planning is kind of interesting because here's what we know. We know one of three things is going to happen. We know you're either going to need the money for some unforeseen event. You just need the money that you funded into the asset-based vehicle. Or two, you're going to get sick and need custodial care. Or three, you're going to die and it turns out you never needed it. You didn't need the money and you didn't need the custodial care. You did not need the insurance. One of those three things is guaranteed to happen, right? Okay, I know that for a fact. I don't even need a crystal ball. It's one of the three. Now, the interesting thing about this asset-based funding option is if you need the money, many of them come with what's called a return of premium feature, where they have a large lump sum access to funds if you need the money. Number two, if you get sick, they can be used and it looks and acts like a traditional long-term care policy where it will pay for assisted living, it'll pay for home health care. Many of them pay for adult daycare like Alzheimer's. Many of them pay for nursing homes. Another thing is they can be structured to have lifetime benefits. You know, you're not going to find that in traditional long-term care insurance. If you go shop around 5, 10, 20 insurance companies that offer just traditional long-term care insurance, ask them if you can get lifetime coverage. Okay, it's not happening. They don't offer it. But in the asset-based vehicle, there is a way to structure them to where you can get lifetime benefits. And lastly, if you die, it's a hybrid and there is a tax-free death benefit to your loved ones. So it's kind of cool. You put some money in. If you need the money, there's a lump sum available. If you don't need the money and you get sick, you have the long-term care. If you die, your heirs get more than you put in and it's tax-free. Pretty cool. Now, which one should you get? Should you self-insure? Should you do Medicaid planning with trust and estate planning? Should you buy traditional long-term care insurance? There is a candidate for that, believe it or not. Or should you use one of the asset-based planning? Which of the four should you use? You know, at McAdams Group, we believe that the planning process should be simple, easy, and inexpensive, and holistic. And if you want a complimentary meeting with one of our planning specialists, just click the link below and fill out a short 60-second questionnaire, and we can help.